Welcome to Real Vision Live. I'm the host this time, Ed Harrison. I am talking to Luke Gromen of FFTT. Sorry for the late start, Luke. We had a little difficulty getting set up. Hope you're doing well.
I'm doing great, Ed. Thanks for having me on. I appreciate you reaching out, and it's always exciting to talk to you.
Yeah, we spoke last June. That caused a lot of buzz because a lot of the things you had to say were really prescient. We had a follow-on actually with Hugh Hendry based upon that, and this is actually the follow-on to Hugh Hendry. This is what I was telling you before. I'm thinking of this as sort of our opportunity to just follow up with that and then give viewers an opportunity to talk to you about the concepts that you and Hugh were talking about I think it was probably two to 3 weeks ago.
Absolutely, yeah. It was a fun conversation, and so I'm excited to talk more about that. It was a very exciting and fun interview. We were both able to trade concepts back and forth and flesh out some issues, I think. So I'm excited to talk.
I'm going to frame up how I'm thinking about it. But first, let me give you a chance to plug your service and what you do, because I was looking for FFTT right before we came on, and I came across the French Federation for Table Tennis. I don't know if you know about this. They have the .com, and you have the FFTT stroke LLC.com. Tell us about Force for the Trees LLC and what you guys do.
Absolutely. So we're a macro and thematic investment research firm, and we aggregate a large amount of publicly available data in a unique manner in an attempt to identify developing economic bottlenecks for our clients. And so we've got a number of different products. We institutional, high net worth, private client, and then we also have a rapidly growing retail registered investment advisor product as well that has been very popular. And so if people are interested in finding out more about us, we are at fftt-llc.com. It's like you said, Frank Tom -LLC, not .com.
Right, not the French Federation for Table Tennis. Right.
Absolutely. No, we're not very good at table tennis.
So, I was looking at your video yesterday with Hugh, and I went through and took some notes and so forth. I'm looking at them in front of me right now. And my sort of basic overarching framework, tell me if I'm getting this right, for how you're thinking about this, is the macro problem that you were addressing when you were talking to Hugh is the one where the US dollar is simultaneously a national currency and the world's most important reserve currency. And those come into conflict in terms of policy initiatives, policy desires from a national level versus the need for the reserve currency at an international level. Is that sort of where you're going with that?
Yes, I think that's exactly right. There's this fundamental tension, as highlighted by Robert Triffin so many years ago. He called it Triffin's dilemma, where when you have the national currency acting as the global currency, you get into domestic policy relative to global policy, and sometimes those two things are at odds with each other. And there are different ways to fix this.
Sorry for interrupting your video, but I have an important message to share. At Real Vision, we pride ourselves on providing the very best in-depth expert analysis available to help you understand the complex world of finance, business, and the global economy. So if you like what you see on Real Vision's YouTube channel, that is just the tip of an iceberg. You should come over to realvision.com and see how we are not leaving any stone unturned, from publishing more in-depth videos, live discussions, written reports, and our latest feature, The Exchange, where you get a chance to engage with experts and fellow subscribers and learn from everyone's experience. It is an experience which you live and you learn from. So if you go to the link in the description or go to realvision.com, it costs you just $1. I don't think you can afford to be without it.
You get into domestic policy relative to global policy, and sometimes those two things are at odds with each other. And there are different ways to fix this. And as I said when I talked to Hugh, they're not particularly difficult from a mechanical standpoint. The issue or the challenge is that they can be quite difficult to resolve from a political standpoint and require certain preconditions and tensions in some cases to take place before the political inertia exists to fix those things.
Yeah, and I think that the most important takeaway for me in terms of the tension is the desire to accumulate dollars on the part of the international community. My takeaway from your discussion was that there's a constant need and desire to accumulate dollars by foreign entities because the U.S. dollar is the reserve currency, and the result is that you have a capital account surplus for the United States, which translates de facto into a current account deficit, which is largely a trade deficit. And so the U.S. is forced, therefore, to run trade deficits on a continual basis as a result of its role as the world's reserve, the holder of the world's reserve currency.
That's exactly right. I mean, it amounts to, and I cited an article in the conversation that in the FT that was really framed the issue in a very clear way, which it was called "How to Diagnose Your Own Dutch Disease." And this system basically requires the United States to be the world's biggest exporter of dollars and of treasuries. And there's a very clear set of results or outcomes from this. And when we first set up this system in 1946 at Bretton Woods, the dollar was the reserve currency, but ultimately the primary reserve asset was gold because the dollar was tied to gold and imbalances were supposed to be settled in gold at $35 an ounce. When we closed the gold window in 1971, then treasuries became the primary reserve asset, displacing gold. And the U.S. had to, like you said, supply the deficits. And so when we supply the dollars for the world to use by running deficits. And so there was this virtuous cycle at first where we export our effectively our middle and working classes, our factories, our jobs, and we, to foreign countries. We export those to foreign countries. We sell those countries then sell the goods back to us for dollars. We then export the dollars. They then recycle the dollars back into the treasury market and other U.S. financial markets. And it's this virtuous cycle that has very clear defined winners and losers around the world and within the United States. And so you see the more quote unquote mercantilist styled countries, the people that are making stuff and exporting it to us, they see rapid economic growth, and you've certainly seen that in China, Southeast Asia, et cetera. And in the United States, you see a very vicious sector rotation so that those in the dollar and treasury export business, if you will, significantly gain wealth, power on a relative basis to those that are seeing their jobs and their factories exported. And so those are the centers of the dollar and treasury export business, of course, are Washington and Wall Street. And so this initially is ultimately a good thing. You get cheaper goods, you get lower cost of goods, you get a widening of margins in corporate America, you get an increase in consumption. Now, in the meantime, what you have to do is you have to replace the income lost by your middle and working classes with something as their jobs are moved to lower cost countries as part of this arrangement. And what has happened de facto has been that loss of income over that span of several decades was replaced by cheap consumer loans. And so you saw consumer lending really increased significantly over that period of time. It arguably culminated in 2008 when we were giving away loans, the ninja loans, no income, no job, no problem, housing loans. But this is all ultimately an outcropping or an outcome of the way this system evolved post 1971. And so initially what you get is basically a big consumer and government debt spending spree under this system. And in the long run, what you end up with is insolvent, over-levered consumers, an insolvent government, and you don't have any industry, or your industry has been so hollowed out that your supply chains to certain critical sectors begins to be hurt. And at that point, it becomes a political problem for the U.S. And my point to Hugh is we're at that point. And in particular, when I say certain sectors, it's the U.S. Defense Department. It's the national security apparatus in the United States that is saying we are now uncomfortably sole sourced on national security, on critical components to adversaries, and to one adversary in particular being China. And so this system has now resulted in it's gone too far. It's gone from a virtuous cycle, and we're now in this vicious cycle, and it's a vicious cycle we're trying to break. And I think we're seeing the attempted breakage of this vicious cycle in the ongoing and rising tensions between the U.S. and China.
Yeah, very well put together from a macro perspective. Now, I want to drill down on sort of the individual bits and then look through some of my notes and where there were questions that you and Hugh had in your interview. One of the things that I thought was interesting is when you were talking, you were making a distinction between Bretton Woods and the dollar standard post 1971. I want to drill down on that a little bit because I think that's an interesting inflection point in terms of what you're talking about in terms of the hollowing out. Because we both know that when you look at trends in terms of productivity growth and worker wages, that's really the inflection point right there, 71, 73, that you see a difference. And what I understand you to be saying is the difference in the systems is that in the Bretton Woods system, other countries could hold gold as their reserve asset, not dollars. Even though it was a dollar system, the reserve asset was gold, and that meant there wasn't the insatiable need for dollars that there is now. Now that gold is not the anchor within the system as it was under Bretton Woods. Does that describe accurately that transition period?
I think it does accurately describe the transition period in terms of, and you can see it in the charts, like you said, where productivity, where profits accrued to. I mean, you can look, real median U.S. wages basically haven't moved since 1971, and right. And that's when I say that there's this vicious sector rotation of who does well and who doesn't do well. I would arguably, especially when you talk about the solution to this problem, at Bretton Woods, I think it's important to denote that there were two proposals. There was the United States proposal that was ultimately chosen, which was proposed by Harry Dexter White, and that was all currencies connected to the dollar connected to gold at $35 an ounce. But there was a competing proposal by John Maynard Keynes, of all people, ironically, which was called the Bancor. And it was basically using a basket of commodities at a floating price in all currencies that would then allow imbalances to be settled over on a periodic basis. And it would then prevent the buildup of imbalances that we consistently saw first under the U.S. Bretton Woods system from 46 to 71. And what we've seen since, which is this system where we have the U.S. issues debt that is never paid off. It's always rolled. It's never settled. And so I think the solution is much more going back to the Keynes system. And interestingly, that's precisely what the People's Bank of China recommended shortly after we did Big QE, which was, let's go to a floating, a neutral reserve asset that floats in all currencies.
Well, I'll say, provocatively. So you're a Keynesian now, basically. Let's talk about the Bancor system and alternatives, and why, when you think of it from an exorbitant privilege perspective, the U.S. would not want to go to that sort of system. So you're basically, and one thing, let me just say that when you talk about Bancors, you're talking about a system which deals with imbalances both on the positive and the negative side, meaning that a country like Germany would also have problems with regard to Bancor, just like the United States, because they have a large current account surplus. So it's not just about the debtors; it's also about the surpluses as well.
I think that's right. I think, and that's when I say it's mechanically, it's a very simple fix, but politically, the outcome of a Bancor would be you would want to line up the world's countries by their current account deficits, and you would find the Eurozone by far with the biggest current account surplus over on the left, and then you'd have Japan, and then you'd have China, and then you'd have a whole bunch of other nations, but it's those three. And then you'd go all the way to the right of that chart, and these would be the nations with the biggest current account deficits, and there's two. It's the Americans by far and away with the biggest current account deficit. And again, it's not because we're bad. It's not because we're necessarily profligate relative to everybody else. It's how the system worked. We had to run the deficits. Right. And then the second would be the UK. And then after that, there's a whole bunch of other nations that run slight current account deficits, not really that big a deal one way or another. And so to your point, what that would imply is within the SDR currency baskets, the euro in a Bancor system where you're settling imbalances in a neutral reserve asset that floats in all currencies is the euro would have to rise a lot. The yen would have to rise a lot. The yuan would have to rise a lot, and the dollar would have to fall a lot, and the pound would have to fall quite a bit, but not as much as the dollar against that basket of currencies, against the neutral reserve asset. And so basically, the Germans wouldn't be real excited about that because it would make their products less competitive. Same with the Japanese. In theory, same with the Chinese, although they've had a much bigger shift towards domestic consumption, I would argue, than either the Germans or the Japanese have been able to engineer. And the U.S. would be much more competitive, except we have already hollowed out our manufacturing base. So for us, it would be great for the U.S. economy. It'd be great for GDP growth. It would be great for the Defense Department. It would be great for the 99% of Americans. It would be terrible for the bond market. And the bond market has effectively dictated policy in this country for 35 years. And as a result, it would be terrible for the bond market. Turns into the Fed would basically have to permanently permanently is a strong word. The Fed would have to be in the business of capping rates for a long period of time, some sort of yield curve control, because given the debt levels, letting the market set rates where it would be with the levels of inflation that would result from the depreciation needed in the dollar under that system would be problematic. And so again, it simply would be the reverse of what we've seen over the last 50 years, which was these mercantilist nations, if you will. Their industries they'd have to start consuming a lot more of their own production. And the people over here running the big current account deficits would have to produce a lot more of their own consumption. And, it would, again, from a mechanical standpoint, it's very easy to do. And it's especially easy to do now in the aftermath of COVID, because you can print money and spend and cap yields and do whatever you want to do from a fiscal and monetary standpoint. And no one's going to ask any questions. But it's a political question, both globally and then domestically in each of these countries, that there are incumbent parties and interests with political power that would be hurt by this outcome, and they are fighting very hard. I'm sure. I can see it here in the U.S. I'm sure it's happening elsewhere as well to talk down the merits of this kind of a potential switch.
My connection dropped out there for a second there. So if I have bad connection, you can't hear me, just let me know and to talk again. I think that that's a very good summation of where we are now. And what I would say is that it sounds to me like when we think back to when you came on in June last year, a lot of your thesis here is about the market forcing that outcome. So to the degree that we don't have a Bancor system, we're in a situation now where we've reached zero rates. And the debt levels have gotten to a level where the market is now saying, okay, now we're in a position where we can force that adjustment onto the system through market forces. And the question is, I have two questions. One, is that a right read of where you are? And then secondly, what does that mean in terms of asset prices, in terms of the US dollar and other currencies?
It's a great question. I think I would tend to agree with that. Basically, we've reached this point where the market is starting to force it, and has been in the process of forcing it. When we talked last June, one of the things we highlighted was how this process had taken place, a 5-year process where global central banks had stopped sterilizing U.S. deficits in 3Q14, and that led to a series of events of the market forcing this. Excuse me. Those series of events: stronger dollar, rising short-term U.S. interest rates, and then you saw FX hedge Treasury yields go negative, and that ultimately forced Fed funds rates above interest on excess reserves, and then you had ultimately that culminate in September last year with the repo rate spike, and the Fed had to begin to regrow their balance sheet. And so you had this the market working to force us in this direction, and then COVID came along and absolutely sort of shattered expectations, shattered the model, and provided incredible political cover to do exactly really what needs to be done, which is, if the U.S. was ever going to go along with this system, it needs to basically have carte blanche and a political cover, domestically in particular, where you get bipartisan support for the U.S. basically moving to a wartime footing as it relates to bringing back manufacturing. Excuse me, bringing back manufacturing.
Sorry to get you up.
Some of my allergies are up today.
You got your water thing going. I've got my my coffee thing going, because we're doing this at 9 o'clock in the morning. Usually we do it at 11. So I appreciate your coming on at all at this particular hour.
No worries at all. So you would need your the political cover, and COVID's provided that political cover. There is now no argument from either side of the political aisle to basically do whatever it takes. You had President Trump implement the National Defense Production Act, or invoke it, back in March, which, again, I'm not a lawyer, but you read through it and it pretty much says the president can do whatever he wants, spend as much as he wants, and the Fed's going to pay for the whole thing, which is, I'm not opining on whether it's right or wrong. All I'm saying is it's exactly what would need to happen if you wanted to move towards transitioning towards the system with a more neutral reserve asset, which is what, like I said, I think powerful interests, particularly around the defense establishment, see the need to do. And so it is the market really, the market plus this black swan of COVID moving us in this direction, it seems like to me. And then the question becomes, okay, what's the Bancor? And in theory, you need another monetary conference to sit down and figure out what the new Bancor is. And I don't think that that's likely to happen in the current geopolitical environment. People aren't getting along, it seems like, all that well to be able to sit down at a table and hash this out. But what I would say is two things. I think, number one, gold is maybe starting to serve as that de facto Bancor in terms of what we're seeing with gold's price, in terms of what we're seeing with gold being purchased by global central banks as a reserve asset instead of treasuries, as we've seen over the last 6 or 7 years. And I also think, too, the market is is moving us in this direction through energy markets. And by that, once you start to see major oil exporters selling oil in currencies other than the dollar, that also helps move this system in that direction. There's an article I was reading this morning highlighting that Russia is actually doing more trade in euro than dollars now. And it's heavily being driven by Rosneft, the Russian oil exporter, responsible for 5% of world oil production, invoicing in euros, not dollars. And so as you start to price the world's most important commodity, oil, in currencies other than the dollar, that leads to a daisy chain of events that basically forces the market toward this neutral settlement solution that we talked about before. So to my eyes, it does look like we're moving in that direction. It looks like COVID has provided some cover to allow us to do this. And I think it's ultimately a very positive thing for the United States, a very positive thing for the world. I don't think is likely to be positive for the nominal value of the dollar over time. But that's a good thing for everybody. If everybody's short dollars, if the dollar falls, that's like covering a short profitably.
Well, that's the thing on people's minds right now is the directionality market-wise of the dollar, DXY, or trade-weighted dollar, whatever you might call it, going forward and where that's headed. That's a relatively crowded trade, the whole proposition that the U.S. dollar is going to fall from here. But if you look at a chart over, say, a 25, 30-year time horizon, even a shorter time horizon, you can see actually that the U.S. dollar, where it's banded since the great financial crisis, is actually not the extremes of the band where the dollar can go. If you think back, as an example, to the Plaza Accord and so forth, there were much greater extremes in the move of the dollar relative to other currencies than there has been so far. So where do you think, to the degree that we're moving in that direction towards a lower dollar, what is sort of the legitimate level that the dollar can get to before people become panicked?
That is a great question. And because that's ultimately another thing that makes this politically tricky, but this might be one of those that actually makes it mechanically tricky. When it's easy to look at, and the top down and mechanically easy, but where it's mechanically tricky is exactly what you described, which is at some level, because we've been running these capital account surpluses for so long, there's a substantial amount of dollar assets out there, right? Yeah, there's $40 trillion in U.S. dollar assets held by foreigners on a gross basis, 11 or 12 trillion on a net basis. And in theory, there's a level or a pace at which the dollar falls where they panic, and then that makes the problem worse, not better. And so to me, I guess I've always kind of thought about it as one of two possible ways, where you sort of get this, move it down to a level, let people get comfortable there, move it down to a level, let people get comfortable there, let it trade down to a level, let people get comfortable there. And so over some span of a period of time, you end up with basically kind of step functioning it down to, 60, 65, 60, something like that, right? Where that's a much better. Now the question is I don't think that can happen over a 12-month span of time without panicking people, without the risk of that flood out of dollar assets where you crash the market, and as foreigners sell dollar assets, you basically get an 87 scenario, right? Which was partly a fallout from the Plaza Accord, where they said, we're going to take the dollar down a bunch. And there was, it led to ultimately some capital flight selling. But because that also gets you into this tricky pro-cyclical problem where if you get a market crash in the United States, we know how the Fed's going to respond, right? They're going to print dollars because, as we saw in March, the net international investment position of the U.S. as a result of the system being in place for as long as it has is so extended. And because the stock market is so high as a percent of GDP at 160% of GDP, and because the stock market is so critical to U.S. consumption, which is 2/3 of GDP, the stock market effectively is the economy. And we saw this in March, where the S&P peaked at, I think, on February 25th and fell sharply through March 9th. And beginning on March 9th, the Treasury market started crashing right alongside the stock market, and kept crashing through March 18th. And so the point I bring up in all this is, if there is a flood out of dollar assets because the dollar's falling too far, then it likely is not going to last very long until you start seeing yields rise in the United States. The bond market starts to sell off as this capital. And that then... And so it is, I bring it all up. I'm mindful of that. I think you could see it. I think all else equal, policymakers would like to see this adjust, get to a level, let people get comfortable, and basically boil the frog slowly. And I think what they're scared to death of is the alternative, which is it moves a little too far too fast. You touch off a capital related selling. And once you touch off that capital related selling, the Fed's got to come in and say, okay, we're going to basically nationalize the credit markets. And, that would get the dollar to a new level very, very quickly. And it might be very good I think it would be, from that point, very, very good for stocks, basically, because you'd basically effectively be implementing a debt jubilee through the Fed, by the Fed basically nationalizing credit markets and leaving the equity out floating. But that's how I've always seen, okay, how do you get it there? I think it's one of those two ways. And I think the policymakers would much rather have it be this orderly, get it to a level, let it trade to a level, and just sort of, do it slowly over time. The question then is do geopolitical events and other events allow you to do that? And I would say pre-COVID, yes. Post-COVID, it's much trickier.
Yeah, as you were going through all of that, I was thinking to myself about Brent Johnson. And, you guys have spoken together on our platform. He has the dollar milkshake theory, which is strong dollar. You're talking about weak dollar. The way that I would actually put the two together has to do with how we're talking about it right now. When I was telling you, if you look back to 86 Plaza Accord to today, you could see that we're trading in a band recently that is actually within the band that we saw over that long period of time. That means that we've gone much higher on the dollar and we've gone much lower on the dollar in that time frame relative to where we've traded recently. So on some level, you could say that it's the dollar's reserve currency aspect which is creating the problem on either ends of the band because of dollar debtors on the one side. That is, if the dollar goes too high within that band, suddenly the debtors who have to accumulate dollars in order to pay off their debts are in trouble. And then you're talking about the dollar asset holders. If you go too low, suddenly their assets from a foreign currency perspective are obliterated. And then that has sort of a daisy chain effect as well. So I think it's interesting. It's again, we're getting back to you want to be in this band, and it's all because of the reserve currency status of the U.S. dollar.
I think that's right. And it's interesting because the people hurt when it gets too strong are the same people that get hurt when it gets too weak on the asset side. And I think it's an important dynamic that if we go back to 2008, it was simple. It was the emerging markets and the mercantilists hurt either way, and the U.S. was sort of in the center and would feel it once it worked its the problems once they worked their way in from the periphery. But we were the last to feel it, and we felt it on very much a lag. And so, quite frankly, we didn't think about it very much. Our policymakers didn't think about it very much. There was a sense of Schadenfreude of, see, you guys are. This is why we're the king, and you're not. And it's King Dollar, hoo-ah. And what's changed in the last 15 years, and really since the 2008 crisis, are a couple things in a very, very meaningful way that a lot of people up until March, we were looking at, a lot of other people weren't looking at, but I think a lot more people are looking at, and it's really twofold. Number one, those asset holders or debtors that are the big debtors, actually I'll say it's threefold. Number one, now there's no one more short dollars sooner than the U.S. government. So, for example, particularly after COVID, the U.S. has a $5 trillion maturity wall due in the next 12 months. That's how much we've issued in bills in the last 3 months. So no one owes more than $5 trillion in the next 12 months. Nobody. And it's not even close. So that's number one. So suddenly the U.S. government is at the front of the line in terms of, or certainly closer to the front of the line, if not at the front of the line in terms of who's the strong dollar hurt. Secondly, the people that were hurt if the dollar got too strong because they're debtors, or too low if their assets got hurt, they're now the majority of global GDP for the first time in 300 years. And that really only happened since call it 2012, 2013. So the last crisis, this was not the case. China is now the world's biggest importer of oil, not the United States. That has never happened before. The majority of consumption of oil in the world is now done by these nations. That was never the case before. So in terms of the real economy, what this relative growth in size that I'm describing does is, instead of the U.S. feeling this on a lag and not that much, as was always the case from 2008 to all the other crises going back in the post-war era, now the U.S. feels it very, 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 very soon and very, very painfully when you look at the percent of revenues and profits of American corporations that are coming from overseas. And then the other point is, when you look at the U.S.'s net international investment position and factor in what the size of the stock market, the GDP at 160% of GDP. When you look at the U.S. GDP, which is 2/3 consumption, and you look at stat we've thrown out in past conversations with you, Ed, and elsewhere, which is the taxable IRA distributions, net capital gains plus taxable IRA distributions are 200% of annual growth in personal consumption expenditures, which is a $13 trillion line item. So basically, U.S. consumption can't grow unless stocks are rising, is what that tells you. And so you now have this system in the U.S. that is geared for stock. The stocks have to rise for the U.S. GDP to grow. And with U.S. debt to GDP over 100%, GDP has to grow to avoid a sovereign debt crisis or to avoid the Fed having to buy a lot of treasuries. And so when we look at this net international investment position of the United States in context of this, what we find is that it's negative 50 to 55% of GDP today. In 2008, it was -8. In 2000, it was -3. Prior to that, it was -1, 1.5. And so again, when it was -3%, the foreigners could, and the U.S. economy was not as geared to the stock market as it is now. Foreigners could have a crisis because of a too strong dollar, and they could then move to sell dollar assets. And the U.S., we'd have some bad days in the S&P, but we wouldn't notice for a long time, and the effects were very muted. Well, now they own $40 trillion in U.S. dollar denominated assets, and so when the dollar gets too strong, it turns into a conversation. We can pretend the trading desk says, "Yeah, hi, I got $40 trillion. I want it, $40 trillion to go. Want it to be done by the end of the week," and that immediately, it doesn't weigh on markets a little, it crashes markets. And it crashes markets like the Treasury market, like we saw in March. And that's a no-go zone. The Fed, in my view, is never going to let the Treasury market crash, because that's simply a matter of national security. And so the set of circumstances that have changed relative to this dollar sine wave, if you will, which I agree with, what it means is these things that have changed is that the reaction, number one, America feels the amplitude of this wave for the first time in a way that is very similar to what only the emerging markets used to feel at number one, and number two, in a much compressed period of time relative to the lag that used to exist because of how important the stock market's become, because of how big these countries have become in terms of corporate profits, and because of how much of our assets they own, how many dollar assets they own, which is just a function of us basically hawking our family silver post '08 to drive growth. So those three things change in an important way. And I think that's important to understand for policy, because it says the Fed's going to have to be quicker on the gun and more aggressive on the gun anytime the dollar gets stronger. They're not just going to be able to let it run for quarters or years at a time like they did prior, in 2008 and all of the prior times.
A lot of that makes sense, and I think that we've had a natural progression in our conversation here, where I would give you pushback, and I think where my idea breaks down from yours, and I think that in your conversation with Hugh, this came out, is about the role of the U.S. government in terms of, its solvency. And so I want to get at some of that here in our conversation. And I was thinking about it in terms of banknotes from the Bank of England. On the Bank of England, I'm looking at it right now on my computer. On their banknote FAQs, the Bank of England says the words, quote, "I promise to pay the bearer on demand the sum of 5, 10, 20, 50 pounds appear on all our notes." And to me, that is basically, it's a metaphor for government. That is that the Bank of England is the agent of the federal government of the UK in terms of printing money, if you will. And so the government, when it makes the promise to pay dollars, it's making a promise which is effectively an IOU. That is that it has no real intrinsic value. I can't get gold from the Bank of England if I go down to them and say, pay me my 5, 10, 20, 50 pounds, as you said on your banknote. They're just going to give me more money. Mm-hmm. So it's fiat currency. And in that sense, there is no bankruptcy. There's no sovereign bankruptcy. In the strictest sense. I mean, you can talk about inflation, you can talk about currency depreciation, but you can't talk about bankruptcy. For me, that's an important concept. How do you look at that?
I agree. I think it's really, it is a provocative way. It's a simple way of saying that there's no way they can keep you money good on a real basis, given what's gone on with the debt and obligation side. And so when I look at, for example, the U.S. situation.
Well, hold on. Let me just say that. So, I mean, basically what I'm saying is when you think about the three toggles for so-called effective bankruptcy, let's call it for the time being, currency, inflation, and actual default, the first two are much more in play, and the third, except to the degree that you have a government shutdown and there's a unwillingness to pay, is basically a moot point with most of the sovereign currency issuers that we know, like the UK, Australia, Canada, and the United States.
100%. And it's very valuable understanding that third toggle is not an option, because once you see the numbers and once you see that the U.S. is having to finance its own deficits, as for the first time in 70 years, as we were highlighting when we talked last June, then you can say, okay, one of two things is going to happen. We don't have the private balance sheet to pay this. So one of two things is going to happen. Either we're going to use the toggle and we're going to go to baby boomers and say, we're going to cut your entitlement payments by 50%. And that's a default. That's a restructuring, if you will. Maybe not a default, but a restructuring. Politically, that wasn't going to happen. And so once we know that toggle's not the option, right? It's like the old Sherlock Holmes. So, once you've eliminated the impossible, whatever remains, however improbable, must be the truth. And that was effectively our case last June, which was, okay, I'm going to make the assumption. I know for a fact the U.S. is having to finance its own deficits for the first time in 70 years. I know for a fact it does not have the private balance sheet capacity to do that. And they're running out of capacity because you can see these symptoms in terms of the rising dollar and in terms of Fed funds over IOER. And if I know those two facts, then, and I can remove the toggle of they're not going to stop paying, then the answer, like you said, is it's the currency or it's the inflation or it's the inflation of the Fed's balance sheet. And then that was really the driver of that conversation. And I think that's still true. I think that's ultimately where we are. And if you look at the U.S. over the last, since the great financial crisis, U.S. federal debt has grown at 8.8% CAGR. And the coupon on that debt, I don't think is ever averaged, post 08, I don't think it's ever averaged much more than 2%, maybe 2.2%, but it's averages obviously way less than that now. And the point is that if you are one of these mercantilist nations that we talked about before, if you will, in terms of the creditors to the system as it's structured, the way you go broke over a 10 and 20-year time frame is you put your national surpluses into a reserve asset whose supply is growing 9 and whose coupon is 1. You're losing 8% per year. You're donating 8% per year of purchasing power to the U.S. government. Thank you very much. Have a good day. And I think ultimately that's why you started seeing global central banks stop buying treasuries and buying gold in 2013, because it's interesting. If you look at what gold has done since 2015, like 8.8% a year. It's you're staying whole. And so, to your point, it's that when I say insolvency, it's really highlighting this dynamic of, you're right, you have three options. You restructure or default, you inflate, or you really depreciate the currency. But it's really, there's only two options. And then it just comes down to, okay, who's going to have to inflate the mostest and the fastest? And the fastest depends. That's what's open for debate, and that's what Brent and I get into all the time. And that has moved from time to time. Up until earlier this year, it was Europe and it was Japan, and after COVID, it's been the U.S. But there's really no debate over who's going to have to inflate the mostest. And that's, again, when we go back to the way the system was structured, we had to run the biggest deficits to supply the dollars. And so, again, it's not that we're bad or we're more our politicians are more profligate than others. It's just the way the system works. So we don't know who's going to have to inflate the fastest, but we know who's going to have to inflate the mostest. It's the U.S. And so then the center of the debate is around who's going to inflate more in the next period of time, and how does that impact currencies?
Yeah, and so Luke, let's think about how this plays out based upon some of the current positioning in markets right now. I think one of what I would call the pain trade which is anti-momentum, has a lot to do with this whole nexus of bull flattening in the yield curve, associated with momentum trades in what I would call long duration type of equity plays. That is that you're not going to get your net present value of earnings until 5, 10, 20 years in the future in companies like Tesla or Nikola, things of that nature. Those people are going longer duration because of the bull flattening. So the pain trade, therefore, there is bear steepening, which could potentially be caused by this depreciating dollar, the importation of inflation, and as a result, long-dated treasuries going up in yield. How do you see this playing out potentially over the, say, next 3 to 6 months, even less, because people are talking about this happening in the September, October timeframe? And how would you position yourself to stop this sort of worst case outcome were this bear steepening to occur?
I think I agree that that's a pain trade. And I think we saw a glimpse of that on Tuesday when we saw gold down, for example, or another really long duration asset. We saw gold down 110 or 120 bucks, whatever it was, as you saw the 10-year sell off. I don't know what it was, 8 basis points or 14 basis points, whatever it was. But it was a sharp sell off tied to increasing issuance. And it's interesting. One of the things I noticed last week was Mnuchin coming out and saying, we're going to upsize the long end. And it highlights this increasingly nationalized U.S. economy where Mnuchin has a lot of control over the yield curve if he wants it. He can, the curve was getting too flat. Uh-oh, we're going to have a recession, or uh-oh, that's not good for the banks. And Mnuchin can get on CNBC and say, yeah, we're going to, and remember, we've got this $5 trillion maturity wall all in bills. I'm going to take $1 trillion out of this maturity wall and I'm going to push it at the 10-year. And we're going to issue it to 10 instead. The 10-year ducks are quacking. Let's feed them. And so he can basically, whenever he wants to do this, he can do this. He did it last week, and we saw it in gold. We saw it in the 10-year. We saw it in some of these long duration growth stock proxies that you referenced. And so, on one hand, if I was sitting in that position, if I had those positions, A, I agree it's a pain trade. B, it would make me nervous because it's basically anytime the curve gets too flat for Mnuchin's liking, I wouldn't be surprised if he just works to feed those ducks. And so to me, one of the things that it suggests is that we're not going to get a flat curve, or the long end's not going to go to zero, because in theory, Mnuchin can say that whole $5 trillion, we're going to do it at the 30-year. And then that was going to do what it's going to do to the yield curve. Now, the flip side of that, and why I think ultimately these long duration trades work from an investment standpoint, even if the pain trade in the short run could be, hey, they could be bumpy in the very near term because of the steepening, is ultimately two things. It's based on, so when former Dallas Fed Chair Richard Fisher said back in 2015, the CBO estimates that what we call U.S.'s true interest expense. It's the entitlements plus the actual interest expense. It's going to be more than 50% of tax revenues soon, and we the Fed have been suppressing the yield curve. And if rates rise, it's a ticking time bomb. This is the president of the Dallas Fed, ticking time bomb if rates rise. And that's with true interest expense over 50%. Well, through June, because of COVID, the true interest expense as we measure it, which is entitlements, health, veterans benefits and services, basically the coupons of the bond-like obligations of the United States, plus the net interest expense, they were at 106% of tax revenues. U.S. has to print 6% of tax revenues just to pay the interest on all the stuff we've spent and promised already. And so the point here is that Mnuchin in the short term can come in and say, hey, we want the curve steeper. You ducks are quacking. Here, take $1 trillion, take an extra 50 billion, whatever it is, and he can steepen that curve. And I think that will cause hiccups in things like gold and growth stocks like we saw. Ultimately, the United States DV01, right? The value, the delta value of a basis point is so great now because the debt levels are so high when you factor in these entitlements, and because the U.S. economy is so financialized. I don't think that you'll have a sustained sell-off in these asset classes because I think enough people understand this math now, and we'll just call BS on the whole thing, which is to say, that's fine. You can back the 10-year up from 55 basis points to 70. Maybe you can take it to 75. And that could be a painful risk off. Now, I don't want to minimize that. You could see that.
And by the way, 72, I saw Charlie McElligott was saying that 72 is actually a number in terms of the derivatives market that is where the pain, that's sort of a trigger point.
Okay,
so
perfect.
Those are good numbers.
So perfect. So they can do that. And so if I had these positions on, and I own gold personally, it's something I'm aware of. Do I lose a lot of sleep over them letting it run to a point or 2 points in terms of the yield? No, because they can't afford the interest payments at those levels with where we are with, and some of that has some sensitivity to COVID and the COVID recovery, and that's something to watch as well. But my point is at some point at 72 or 70, whatever it is, I know on the other end of that, Fed yield curve control comes in. And so I got Mnuchin on this side basically saying, I'm going to keep the curve up steep. And I got the Fed on this side saying, it ain't going to get too steep. It's going to, the interest rates are going to stay at politically expedient levels, and politically expedient means levels that don't basically prevent the U.S. government from being able to fund itself effectively. So I think that the pain trade could be bumpy as a result of that in the short run, but I think ultimately it is these duration plays make a lot of sense in the context of this, of where the fiscal situation has been allowed to evolve. And in particular, once we had this catalyst of COVID, what it did to the economy. And then the last missing piece was what the Fed did in March and April, which was the Fed came in March and April and grew its balance sheet at a $35 trillion annual rate. And when you and I were sitting down in June, if you would have said, Luke, hey, in 9 months, the Fed's going to grow its balance sheet for a period of time at a $35 trillion annual rate, I would have looked at you and said, I think they're going to grow their balance sheet, Ed, but I think you're crazy. But they did it, right? And I think that then removed, but all these trades, all bubbles have like an element of truth to them, right? So that's not say, the duration trade, I think, understands it on some level now. I think maybe in the short run, it took it a bit too far. We saw some of the removal of that froth earlier this week, but I think that's ultimately the right trade. Ultimately, they're painted into a corner, they being the fiscal and monetary authorities.
Yeah, very interesting stuff, I have to say. I'm looking at the time, and we're about at 55 minutes, I think. So I'm going to just run through all of the questions. Usually I do the questions in the middle, but I thought we had a really good conversation. It was a good flow, and I'll just do a rapid fire round of the questions that people are asking.
Excellent.
So here's the first question. Evans Jonathan, he's asking, what's going to stop central banks just printing money and kicking the post-2008 problems down the road for another 10 years?
I think ultimately the answer's inflation that they can't disguise, hedonically adjust. Inflation that gets so bad that at the CPI level that it's impossible to mask, and it affects political processes. But before then, I don't think there's anything that would stop that.
Okay. Nick here is, Luke has talked in the past about equity market cap as a percentage of GDP, which that's true. Net of publicly held treasuries, though. And we talked about this actually in June. Can you give us an update on your latest views on equities in the context of this particular measure?
I haven't updated that model recently, but of course with the treasuries that are outstanding, and the gist of it was for the uninitiated, we looked at total equity market cap as a percent of GDP, which is known as the Warren Buffett metric, right? Historically, when it gets over 100%, things are a little frothy. And what we said was, we tinkered around with if you have to X out the treasuries outstanding, because it effectively turns it into an enterprise value to EBITDA measure, basically. And our view was we do that because the treasury, given the fiscal situation, those treasuries are eventually going to need to be bought by the Fed, and so you sort of strip that away, and that then adjusts the equity valuation as a percent of GDP. It sort of normalizes it, and it ended up being a surprisingly good metric in terms of forecasting. Hey, the more treasury issuance goes up, the more the market's going to go up, and I like I said, I haven't looked at it recently. I still think it's a good metric to use, and I think given what we've seen, my guess is it suggests equities could continue to go higher as a result of what we've seen in terms of issuance over the last several months.
Great. I'm going to go out of order here in terms of the questions that we've gotten, because I think this is a great one here from Thomas. As I was telling you from the beginning, I was thinking about this as a follow-up to you and Hugh talking 2 or 3 weeks ago, and he's right on this. He's saying, please ask Luke where he and Hugh have widely differing opinions. And so the way I'm taking this is now that you've had a chance to think about the interview that you had with him, where do you see the difference between what you were saying or what you are saying and what Hugh was saying in that interview?
It's interesting. I had one of my best relationships on Wall Street, who's a senior portfolio manager at one of the biggest hedge funds in the world. He pinged me and he said, after he watched it, he goes, Luke, I think the only difference is Hugh is saying should and you're saying gonna. They should do these things and you're saying they're gonna do these things, or they are doing these things. And so I think from an overarching standpoint, I think that's the one big difference. And I think the other one is the ways in which I see the system already evolving towards multi-currency energy pricing, in particular multi-energy or multi-currency commodity pricing, and how that's already basically creating some of the market forces that are moving the world towards the changes that we see evolving over time. I think there's probably some modest differences between our views, where I think he looks at a lot of what the U.S. has done post 1971 as being purely out of benevolence hegemony.
Benevolent hegemon, I think he called the United States.
He called us, yes. And all else equal, we have been fairly benevolent. As an American, there are some things I think we've been very benevolent on. And I think there are some things that we did that had very little to do with benevolence and much to do with realpolitik around that dollar system in particular. So, but ultimately, those are I would argue are pretty semantical, or if that's a word, differences. I think the big two are really the should versus gonna, and then where they are in terms of this multi-currency energy pricing system evolving.
Right. Okay, that sounds great. Let me go to the next question here. This is Cyrus. He's asking, what are Luke's views on the potential for dollar devaluation, stroke debasement, and higher currency supply to reduce deficit? Or does he feel debt will be handled through a jubilee and higher taxes?
I think it's much more likely they'll be handled with increasing money supply by the monetary authorities, and this will not be a U.S. Phenomenon solely. And that gets into that. We know the U.S. is going to have to print the mostest by the time all is said and done, given the system. But for currency traders, what's important is who prints the mostest the fastest, and that's open for debate. I don't think a jubilee in the strictest sense of the word, or in the broadest sense of the word, is likely. I think you could see it in certain areas. For example, I think it is possible to have a student loan jubilee because of the structure of that market. So much of that market, the loans are owned by the U.S. government. And so that market, you could do a traditional debt jubilee. It's you don't have to pay anymore. Remove liability from this side of the account, remove the asset from this side of the account for the government, and because they have the printing press backstopping it, there's really no losers there. That is a policy option that would be wildly popular and I think quite inflationary for asset prices, probably negative for the dollar, but I think that would be good for a lot of the world. A broad debt jubilee, though, I think is very unlikely to happen, simply because when you look at the setup of the system, again, the debt of the 99%, quote unquote, are the assets of the 1%. And so to write down or to write off or implement a debt jubilee on the debt of the 99% would require a write off of the assets of the 1%. And politically and practically speaking, I just don't think there's very much of a chance of that happening. I think it's much more likely, and history would support this, that you're much more likely to basically inflate it away over time and through increasing monetary supply or fiat money supplies.
Right. Okay, let me see how many more questions we can take because we're at just over an hour here. Let's just keep on going for a
Yeah,
little
I'm good.
bit.
I'm good.
We've got Sedipto Data, and here's the question: does the dollar milkshake theory still apply with the present market situation? We keep on hearing about the U.S. dollar outstanding debts across the world. Will that counterbalance the dollar weakness? That goes to something that we talked about, but maybe you can address this question specifically.
Yeah, here too, to my view, the dollar milkshake theory is still in play. It is now, however, in the aftermath of COVID, I think almost entirely, if not entirely, in the hands of policymakers. And by that I mean, if Mnuchin wants to refinance part of this $5 trillion maturity wall at the long end, he can create a dollar milkshake. Not that that's going to work out well for any of us. It'll be, blowing up us as much as the rest of the world. If the Fed wants to create the dollar milkshake, it too, if the Fed says, look, we're going to sell, we've got whatever, 6.8 trillion on our balance sheet. We're going to be 6 trillion by the end of this year. That would work the dollar milkshake too. Dollar's going up, everything else is going to go down. There's not going to be, but ultimately, in terms of the dollar portion of the dollar milkshake theory, right? I think though that what we saw in March was the dollar milkshake theory in a way. We saw the dollar up to 102.5 or 103 on the Dixie, and that was what broke the world. And so I think that was the right view. I just think people thought it would be 110 or 120 on the Dixie to break the world. And the reality was it was 102, 103. And so that's where the Fed stepped in to alleviate the pressure. And so I just think it is very much a function of, basically policymakers at this point. They can get the dollar up really anytime they want, but they can't let it go too far. So that's, I think, the reality of the situation in the post-COVID.
Okay, great. This is a question I would want to ask you myself. It's a two-parter from Lee. He's asking you, Luke, he says, does Luke think the pullback in gold and silver has more to go? That's question number one. Question number two, also, where does Luke think Bitcoin goes from here?
Okay, gold and silver. I wouldn't be surprised if it pulls back just a little bit more. But boy,
and how much of that is related to bear steepening, and how much of that is just related to the dollar being, gold and silver being overbought?
I think it's more being overbought. To the point where you look at some of the sentiment readings, they were very extreme. I mean, I saw one gold was up 13 or 14 trading days. That had never happened. You could see the level of froth just in terms of some of the subjective sentiment measures, the objective ones. And so it didn't take much. So I would ascribe most of it to it just being overbought. And then you had that steepening. I just don't think the steepening can go for very long. And away from what I think, which doesn't really matter, the U.S. fiscal math suggests the steepening can only be allowed to go for so far. And so that's why I say, could it pull back a little more? Sure. But to me, gold's been my biggest position. I haven't sold an ounce, and I'm not losing any sleep over it just because ultimately, the big gear to this trade is this fiscal situation, the untenability of this fiscal situation, and what it appears likely has to happen over time. But you're going to get these periods of volatility, between here and there.
Right. And what about Bitcoin? Do you have a view on Bitcoin at all?
I still really like Bitcoin. And there's probably 100 guys you could talk to that will explain all the details better than me. My view is that ultimately, a number of those guys I listen to and I agree with them. And I think I just look at it as it's digital millennial gold, basically. And so it's a smaller position for me relative to gold. I think I've got probably 2-3% of my assets in Bitcoin. And it's something some of the reason it's not bigger than that is I still don't know enough. It's a comfort level thing for me. I still don't know it well enough. It doesn't have the track record as much. Central banks don't own it. They own gold. So there's some reasons I'm not bigger, but I'm still learning more and more about it. But bottom line, to me, it is a neutral settlement asset at a floating rate, digital for the people. And that to me is of interest as a result.
Great. Now, let's see. Larry, he asks this here. You say that mechanically this shift, I guess he's talking about the shift down in the dollar, would be fairly easy. However, do you really think that the U.S. will give up reserve status while essentially foregoing its sovereignty? This is the kind of thing that countries would go to war over. And, let me just let me add my color to how he's positioning this. I'm thinking he's talking about the exorbitant privilege, which to a certain degree, you can talk about the 9% increase versus the 1% that you were discussing earlier. Right. That's something that's good for the United States. I'll call it the exorbitant privilege. The U.S. doesn't want to give that up.
It is good for the United States until it requires us to go to China and beg for masks and beg for pharmaceuticals and beg for rare earths to make the missiles to aim at China. And and I think COVID was very big in demonstrating exactly how fragile our supply chains are to the general public and to policymakers that weren't paying attention for any number of reasons in Washington. The Defense Department, as I'm sure you're aware, has been talking about these supply chain vulnerabilities for at least a couple years. And the reality is it's more like 8 or 9 or 10 years vis-a-vis China. And so to be clear, I don't think the United States is going to give up reserve currency status. I think the United States is going to change the structure of the U.S. dollar reserve status, as we've already done once. We did it in 1971 because it suited us. And once again, it suits us. And it suits us because we don't want to have to beg the Chinese for rare earths if we have to fight the Chinese, because they're not going to give them to us. And, oh, by the way, they're also not going to give us antibiotics, right? So, the first fallout of a quote unquote war with China would be no more antibiotics. And how many tens of millions of Americans die in the first 6 months without the antibiotics? That's a no-go. It's a vulnerability that was highlighted by COVID. And so what I think is going to happen is not that we lose reserve status, but that the structure of it changes. And it already is changing, arguably, where instead of the Treasury being the primary reserve asset of the world, something else is the primary reserve asset. Gold, I think, is looking like it's, at least until some sort of monetary conference down the road can establish something else, the de facto primary reserve asset at a floating rate, not at a fixed price. And what this then does is it basically gets us out of the Treasury export business, because when the Treasury is the world's primary reserve asset, the United States' role in the world is reduced to basically consumer of last resort, and we're getting too old and too levered to do that anymore, and to export dollars and treasuries to the world while they make stuff for us. And that de facto in the last 10 years has meant we supply China with the dollars to buy up finite raw materials around the world and finite real assets. And then we actually also do them the favor of defending the sea lanes for them while they bring it back to China. And this is something the Defense Department has highlighted. It's something Trump has highlighted. And so the bottom line is, as the 1946 to 71 structure of the reserve currency status didn't suit us in 71 and Nixon closed the gold window, as in 1933, where the $20 per ounce as structure of the dollars, at that point it was a competing reserve asset to the sterling, but that didn't suit us, and FDR unilaterally devalued the dollar and then also made it illegal for Americans to own, changing the structure. I think we're going to change the structure because it doesn't work for us anymore. And so it's interesting. A lot of times I get people push back of, this is bad for America if they let reserve currency status go. And I say, no, well, the current system is no longer good for America because, and COVID was a perfect example. We are at the grace of the Chinese. They make so much of what we have, and and of critical components that we need for national security is really where the rubber meets the road, whether that's rare earths, whether that's pharmaceuticals. It's simply a non-starter anymore. And so my view is that you're going to see a change to U.S. and that will impact certain areas. This is all else equal. The best way to sum it is the dollar can fall sharply without losing reserve status. And I think that's exactly what's going to happen.
Right. So two more questions. One from the audience, the last one, and then I have my own question to end it off with. This last audience question is Joe Rich. He's saying Mnuchin is likely the most Wall Street friendly Treasury Secretary in recent U.S. history. How does Luke see Treasury policy changing in a Biden administration? If we get to that, obviously.
If we get to that, I don't know that. I would argue that he's the most Wall Street friendly. I mean, we had Paulson, we had Rubin. I mean, these guys were pretty darn Wall Street friendly.
Geithner.
With that said, I don't fully know. I think it's going to depend to some degree on what the policy is from the top down. I think.
How much of that is China related? Meaning that, you were just talking about the problems with China to a degree, therefore, with regard to reserve currency status and the concomitant impact on markets, it has to do with our China policy.
And it's a great segue, because that's where I was going to take it, is ultimately, if you want to change the U.S.'s interaction with China, de facto, you have to change the relative power of Wall Street. And the reason that within U.S. domestic politics, and the reason that is Wall Street, as much as anybody, benefited from the Treasury export business. And so if we want to change our interactions with China so that in ways that I described before, you have to reduce the importance on a relative basis of the Treasury export business within U.S. domestic industry, within domestic U.S. policy circles. And so I think Mnuchin has been, and who knows, I don't know well enough to know if he's done this willingly or if it's been kicking and screaming, but this administration, particularly post-COVID, has moved in that direction towards reducing the relative importance of the Treasury export business. And so the question to me, the lens I would use to evaluate what might happen under a hypothetical Biden administration would be, are they continuing to push this China, will their China policy be a continuation of the Trump administration? I'm told that China doesn't think it will. China wants Biden to win. And if that's the case, then de facto, whoever's Treasury Secretary for Biden would be much more Wall Street friendly than Mnuchin, because they would be de facto supporting the Treasury export business more than what Mnuchin has done as part of being the Trump administration.
Right. Very good answer, I think. So here's my question. I'm springing it on you without warning. It's about three guests people that you would like to see on, that you would interview. Here's how I'm thinking about it. If now you are the interviewee. You've been 3 times at a minimum, twice by me and then by Hugh Hendry over the last year or so. If you were the interviewer, which I'm sure that we could do, who would you want to talk to that you've seen on the platform or you are friends with, who you think could add value? You don't have to even give me 3 names, 1 name, but what are your thoughts?
Gosh, there's There's a few.
I know that's a very
it's such a there's some guys that I know I would love to do. I don't know if they want me dropping their names publicly. It's boy.
Here's what I'll say is we'll adjourn that question. Let's have you think about it, because the way that I'm thinking about it is I think this was a good. I look at it as a good completion of you being on the spot. Now I think it's time for you to put someone else on the spot. And so let's think about doing that. Because I really enjoyed talking to you today. I think it was a good follow-up to what we did with Hugh, and for me, it really fleshed out your ideas from that interview in a very cogent way. And so I'm really happy that you took the opportunity to talk to us today.
Oh, thank you very much for having me on. It's a lot of fun. I mean, if I was going to do anything, it would probably be fun to do something really informal where you get a couple, three people around a table, and you get the cameras rolling and you see what comes out, and just let it be very organic in terms of the development. And it would be fun. It would be fun.
Yeah. So, now you've gotten my mind thinking about that. Yes, I think that's something we'll talk about that for sure. Luke, thanks again, and we'll talk to you very soon.
Thanks again for having me on. It's always a pleasure talking, Edward. Really enjoyed it.
Thank you for watching this interview. This is just a taste of what we do at Real Vision. To learn more about the complex world of finance, business, and the global economy, click on the membership link in the description. Give us 7 days to change your life. This will be the best dollar you ever invest.